Welcome to the Lend Academy podcast, episode number 53. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Fiona Grandi. She is a partner at KPMG and sort of the lead of their Fintech marketplace lending practice. And she has somewhat of a unique perspective on this industry because she works very closely with some of the major platforms. She works closely with some of the major investors. So she sees this industry from an interesting perspective. So I wanted to get her on the show to talk about, some of the recent news as well as, how the industry is doing when it comes to compliance and regulation, what we can do better. And also we touch on, what she thinks will happen in the future. Hope you enjoy the show. Welcome to the podcast, Fiona.
Thank you, Peter.
Okay, let's get started by just giving the listeners a little bit of information about your background and what your role is at KPMG.
Sure. I'm a partner at KPMG and am currently the consulting leader for the San Francisco Bay Area and have been with KPMG for 20 years this coming year. But what's probably relevant to this discussion today, Peter, is that I lead our Fintech practice nationally. I'm a financial services and banking partner. I spent my entire career in that. And I'm heavily supported by partners in our emerging technologies, venture capital, alt-fi funds teams as well.
Okay. And so how long have you been focused on the fintech space?
We've obviously watched the changing landscape of banking for years, but I think there was sort of a pivotal moment maybe for our firm about 3 years ago. Every year we host an international financial services conference and everyone flies in from around the globe. 3 years ago we held it in San Francisco, and as you would expect, fintech was a significant part of the agenda. Mm-hmm. And it was attended by KPMG and clients, and there were hundreds of people there. And what was really interesting is we had companies like Coinbase, Prosper Marketplace presenting, but we also had the big banks there. So we had John Stumpf, CEO of Wells Fargo, speak. And it was interesting because it was sort of a lightning bolt moment for me hearing Ron Suber talk, and the immediate next presentation was by John Stumpf, and just the dichotomy of their perspectives. Now, this was 3 years ago, and a lot has happened in 3 years. And I think if you would fast forward to today, everybody is talking about it. Everybody's actually changed their business models, every one of the big banks, whether, they're building or partnering, as we've seen in the news.
Okay. So then when did P2P lending first get on your radar?
Probably, before that, it became a separate industry group for KPMG in 2013. That's probably, if you were to track our activity and our investments, we made a big change back in 2013. We were the first of the big four to make a significant sponsorship with Lendit. We started to issue white papers and really get out in front of the market and the trends with our thought leadership.
Mm-hmm. Okay. So can you just sort of explain what KPMG's role is? I mean, what are you actually doing in the marketplace lending industry today?
Sure. So, it's really the core of our primary services, which are audit, tax, and advisory and consulting services. I think what has been unique with us is that we've been supporting from a pre-IPO, actually through IPO now with those that have gone through IPO, and also brought kind of our global team. So I sit on a global fintech leadership team that represents right now 9 different countries. And so some of our best thinking is coming from those teams that serve peer-to-peer lenders, in Sydney or the UK or Israel. It's really an interesting time. I think that when you think about the whole ecosystem, where does KPMG fit in? Well, we kind of fit in on all different sides. We work with the banks that are investing, that maybe are looking to us to provide some independent perspective before they invest their dollars. We work with the platforms themselves, trying to get them matured, whether it's a back office, middle, or front office perspective. We certainly work with the funds. And then I think one of the key differentiators right now is our innovation services that we've really been developing probably over the last 5 or 6 years. We bring banks into our innovation labs that we have in the U.S. or globally, and we try to pair them up with fintech companies. We are doing presentations on some of the most groundbreaking and innovative things happening in peer-to-peer lending. And part of that is also the alliances and partnerships that KPMG has entered. And I'll give you just a couple of examples. I think you know of Matchy, which is the matchmaking service between fintech companies and financial services more broadly. But we also have alliances with news companies like Owlin, which is a news alert service. And KPMG and Owlin have created a technology trends index, which is just pretty amazing.
Okay. So I want to actually just dig into a little bit of that. Like you mentioned the fintech lab that you have and you're bringing banks together with innovators. I mean, can you just describe that in just a little bit more detail? So are you making introductions? You kind of driving joint ventures? What does it look like?
We are making introductions, and it's really across a spectrum of what banks are doing, because if you look at the first and second tier, certainly in the U.S. and possibly globally, they're all taking different approaches. Some of them have their own innovation labs, so they're bringing us in to kind of pitch us and get our feedback as an independent player. They're also looking to buy and partner, so they are looking for introductions, absolutely. And, typically they're coming to KPMG and saying, we have a problem that we need to solve. We don't have the right customer experience happening. And these platforms do. How can we get it, or how can we leverage the platforms to expand and reach more customers? So I think it's a conversation that is certainly multifaceted.
Okay, interesting. So I want to talk about your white paper that you put out a few months ago, earlier this year, and it was interesting because it wasn't like a lot of the other white papers I read, which is sort of like, here's an overview of the industry and this is where we think it's going. Yours was a very specific, you took one topic and really drilled down into it. And, the title was, values-based compliance, a marketplace lending call to action. And so I wanted to sort of spend a little bit of time on this because I think it's important. And let's just talk about compliance. And you actually talk in the white paper that that many platforms, in fact, that you start working with, they really are not doing a very good job when it comes to compliance, but that it is improving. So, what does the industry need to do when it comes to compliance, and what are they doing? What are the people doing wrong?
Well, I think that these platforms are coming from a place of addressing a need in the market, but essentially their technology, their unique differentiation is the technology. And so regulatory compliance, while they may have, a chief risk officer or a lobbyist and a compliance officer in-house, it's not necessarily a core competency throughout the company of these platforms. And so I think that they struggle to really embed some of the fundamental concepts of just thinking of compliance in day-to-day tasks. So compliance often tends to be more of a bolt-on rather than an embedded component within the organization. But, are most companies doing it wrong? I don't know if I would say they were doing it wrong. I think given their patterns of growth, it's hard for them to invest in things like regulatory compliance and back office, maturity. Mm-hmm. So, but we have seen some really significant changes in the last 2 years. And this, as a result, obviously, we've had a couple big IPOs. That is certainly bringing up kind of the base level for everybody in peer-to-peer. And we've also seen, and KPMG plays in this space, that the funds and the institutional investors are the ones, probably more so than the regulators, that are asking for, what is your OFAC program, or what's your anti-money laundering program? How do you deal with these types of regulations?
Right.
And so it's really, you're seeing everyone start to make a focus on compliance.
Right, and let's just use that as a segue. I mean, we're recording this, on December 11th, which happens to be the 1-year anniversary of the Lending Club IPO. But it also, I wanted to talk about something that came up earlier this week, where it became apparent that one of the shooters in the San Bernardino tragedy took out a loan, apparently through Prosper via WebBank. And that has created a major kind of firestorm in the media. And I've been interviewed many times. I'm sure you've been on the phone a lot this week around this issue. And I guess I'd like to get your thoughts firstly on, do you think that there's these platforms have done or need to shore up some of their OFAC. In fact, I'd like you to explain what OFAC is as well, and the AML stuff that there's been some people questioning it this week. So I just wanted to let's first get your thoughts on the events of this week.
Sure. And, I have to qualify what I'm saying, that, these are my views and not the views of KPMG, and much of this information, as you just described, is coming out sort of daily and evolving. It's really difficult to look at the circumstances of the loan that was made and the connection to the very tragic events to say that a bank would have made a different decision than the peer-to-peer platform made. When you look at the villains in this, we're talking about somebody who is a U.S. citizen who had been here for several years, and it's hard not to see that this is sort of a little bit of a canary in the coal mine trying to alarm, the U.S. population around just some of the challenges in our regulatory system. But when you peel back the onion and look at the facts and circumstances, would it have been different if another one of the top 5 banks had made that decision?
Right.
I think you've probably seen the news today that the California Department of Business Oversight indicated that, they're coming out with their own inquiry, launched, I think, officially today, and there's certainly increased scrutiny coming. But when I look at the San Bernardino circumstances specifically, it's hard to say how we would have prevented that and what regulation needs to do to further protect, the U.S. I think a lot of the focus is around small business more conceptually. When you think about the Consumer Protection Board, the CFPB doesn't have protection over small business. And that's what the California Department of Business Oversight is going with their inquiry. They're trying to see how money can pass through loans. And the question is, can an individual fund sort of a specific loan and pass through dollars to bad players that are out there? And how do we protect against that? And it's a very difficult question to answer.
Well, I tell you, it's while it's not impossible, it's certainly, I've been investing on these platforms for many years, and I look at all, the new platforms, and there's really only Prosper and Lending Club today that are open to non-accredited investors. So one, you have the accredited investor hurdle, which may be able to overcome, but then a lot of times it's blind. How do you know when you apply for Lending Club and Prosper, you don't know whether that's going to go on the whole loan platform and going to be done by an institution, or whether it's going to go on the retail platform. So the way I look at it, the systems we have in place today prevent, if you're a bad actor and you want to funnel money through these loans, it's simply there's no way to do it where you can guarantee you're going to be able to do that. But so I think that's something that's good that we have in place today. But then we obviously got the House. There's a House Financial Services Committee that's also looking into this. Do you feel, and again, it's your personal opinion, that anything should change as far as a result of what has gone down the last couple of weeks?
Clearly changes are coming, so that's guaranteed. I feel safe saying that. Mm-hmm. I think we really need to evaluate the expectations of the peer-to-peer and marketplace lending platforms. What bar are we holding them to? When you think about the specific events that came out this week, are we expecting marketplace lenders to catch things that our own FBI, they didn't see red flags, they didn't trigger. So I think we need to step step back, take sort of a broader picture, I do think that the marketplace lending landscape does provide scenarios that certainly regulators and government did not contemplate. And so how does that potentially change some of the risk profile that OFAC and anti-money laundering, and OFAC being the Office of Foreign Assets Control, that those laws and regulations are intended to protect us.
Right. Can you, I just want to stop before we go on to another topic. I want to make sure, can you explain OFAC, what it is and what it has to do with people trying to obtain a loan from the platform or from anybody?
Sure. I think that OFAC, is really a financial intelligence enforcement agency. So it's a component of the U.S. government, and it's supposed to prevent terrorist dollars, bad actor dollars from funneling money, laundering money, pushing money through the U.S. regulated system. So it's a protection. And so there are things that platforms, that banks, that anybody that is passing money through has to comply with. Checking against the OFAC list for bad players' names, having a certain amount of, in bank regulation, we talk about know your customer. So there's specific laws trying to protect us from, moving around the money of the bad players in the market.
Right. Okay. Well, let's move on. But I want to stay in the legal arena just for a few more minutes here and talk about something else that is topical this year and last few months is the Madden versus Midland case. Could you talk about a little bit about this case and what you are advising your clients around this case that has now gone all the way to the Supreme Court?
Sure. And I'll have to preface it, Peter, by saying, I'm not a lawyer and certainly don't want to be giving any legal advice. Great. Right. We're in the same boat. We're not advising specifically any immediate action. I mean, the ruling applied across 3 specific states. It was New York, Vermont, and I think it was Connecticut. And basically, I think it wasn't surprising, at least to me, that the ruling stated that platforms that are working with originating banks are not exempt from state usury laws. So I guess it wasn't surprising, but what would you do with that information? Well, I think the platforms, the peer-to-peers, really need to look at what percentage of their loans are affected by the ruling, what are their biggest exposures in the specific states named, and do some, risk analysis around that. It shouldn't be a difficult exercise. And I think the platforms need to be prepared that their boards and venture capital partners, their investors, are going to be asking about this if they haven't already.
Right.
It's definitely, it's an indicator that the regulatory regime is changing and but it takes time to respond and react. I think we just have to wait and see how this all plays out.
Yeah, speaking of waiting and seeing, we had the Treasury RFI over the summer. I think you guys were the only Big Four accounting firm to actually do a response to.
We were brave.
Yes, to the Treasury, and I read through your response just the other day, and one of the things you mentioned was data protection as one of the key things the industry needs to focus on. And the fact is that we haven't had a cyber attack, at least not a major one. So can you just talk about what does the industry need to focus on when it comes to cyber attacks?
Sure. And I think one of the reasons why we called it out in that Treasury RFI request for information was because it's certainly a significant risk in any banking industry, right? If you just think about the nature of PII, the personally identifiable information that comes with loans and accounts, it's easy to see how the platforms, the peer-to-peers, are certainly exposed as the banks are. And so I think the comment was more around making sure that in marketplace lending, that as we think about what the risks are, that cyber is also at the top of the list. I think thinking about security and data protection, information protection, it's not necessarily a core competency for these fintech companies. And so them, to not spend time focused on it and thinking about how they may have different risk exposures because they're so mobile, because of the nature of how you provide them data and how your loans get funded. I think they'd be putting themselves at risk if it wasn't at the top of their risk assessment list.
Right. So, and one other thing you talked about there was, skin in the game. This was one of the things that the RFI seemed to be most interested in. And you had an unusual, a different approach, I guess. Can you talk about, you talked about maybe an alternative to what people traditionally think about as skin in the game. And I don't think you provided a whole lot of detail, but can you just expand on what you were thinking there?
Sure. In banking, we talk about skin in the game in terms of risk retention. So with peer-to-peer, we're talking about actually taking loans onto the balance sheet and what that means, thinking about the platforms that don't do that. So do they truly have skin in the game? And I think our comment was really directed at there's absolutely skin in the game. One of the key foundational concepts is around the transparency of the loan portfolios and seeing exactly what is happening in terms of loan characteristics and data accuracy. And so in marketplace lending, that's the skin in the game. If you look at from a macro perspective, the interests of these platforms and their investors are absolutely aligned. If you have a loan that doesn't perform, even though it's not on the balance sheet, you lose your investors and ultimately the market share. On a micro level, if an individual loan fails, you lose those critical servicing fees that are part of the success of many of these platforms today.
Right. Yep. No, that makes sense. So I know that in your work you talk with a lot of the large banks, and so I want to talk a bit about that. And when we set up this interview, we didn't know that Chase and OnDeck were going to actually announce a partnership, but we know that now. And I had a chat with Noah Breslow, the CEO of OnDeck, and we talked in detail about this deal. Do you think that? Well, firstly, I guess two-part question. One is this a game changer for the big banks? And do you think that in a related way, is this a blueprint for other deals, or do you think other banks are going to take a different approach?
Yeah, certainly the Chase OnDeck deal was very exciting. And it's a bellwether moment for the industry as a whole. But I don't know that I could make any more predictions in this evolving industry. We've had so many great groundbreaking moments, some of which were announced at Lendit last year. Will there be more of the same? I think we definitely are going to see banks, the biggest banks, moving in this direction. Some of them are building, thinking about Goldman. Others are partnering, investing, looking possibly to acquire. Funding Circle and Santander had been kind of moving in this direction from before. So I think you'll see a lot more of this. And the banks are acknowledging that the platforms certainly have something they don't have, whether it's the proprietary algorithms or just the differentiated customer experience. The banks recognize they cannot fit some of these smaller dollar loans into their existing sales channels, and yet there's an opportunity in the market there. So they need to get in somehow, or they're just going to miss that opportunity.
So do you think that's the big change then when it comes to big banks over the last couple of years since you've been talking with them, is that now, before they sort of, you talked about Ron Suber coming on before John Stumpf, and that's such different perspectives. I'm wondering if that same duo came on today, whether the perspectives would be still very different. It seems like, from my perspective at least, that banks are now realizing that this industry is here to stay, that this is something that they can actually benefit from and do and help them grow. And it seems like that's been a big change from ignoring it to using it as an opportunity. Is that fair to say? Absolutely.
I think you're right. I think it's, marketplace lending is here to stay. I think any one of the banks would have said 5 years ago, technology will change us. Well, I think today they understand better and have now, in the last couple of years, spent resources and dollars to embrace that change. And just as you said, they see it as a market opportunity. The real test is going to be, is we see this, interest rates increasing for the first time potentially, and listen to all the industry experts that are talking about what those rate increases are going to do to the marketplace lenders. That will be the testing ground. And we will see what the big bank appetites are going to be as those rates change for the marketplace lending market.
Right. Although, if we get a quarter point move on interest rates, it's not a dramatic, it's not going to change the scene dramatically, I wouldn't think. But yeah, who knows where interest rates will be, this time next year or in 2 years. So I guess it's certainly a fair question. It's one that gets asked a lot for sure. So just a couple more questions before I let you go. So I've been asked by reporters a couple of times this week about what is the industry's response here? What is, for around the whole San Bernardino thing, and the fact that we don't have a trade association yet. It seems to me that this is now becoming more and more important. I mean, what are you hearing in your conversations with the marketplace lenders around that topic?
Sure. Trade associations are an interesting concept. It's hard to say whether we will have one in marketplace lending and how necessary it is. What I do think is necessary is the movement towards self-governance, or trying to be out in front of regulation and being thoughtful and sort of consistent across the marketplace. If you think about the Small Business Borrowers Bill of Rights, came out, I think it was early August of this year. That was really pivotal. That was a consortium of platforms coming together, including big names like Lending Club and Funding Circle. And the purpose of that Borrower Bill of Rights was really just to define the fundamental financing rights for small business borrowers in the lending process. But what it did was really raise the bar for the whole industry. And so that kind of self-governing activity that pushes responsibility and accountability is going to be the thing that really supports the industry as a whole.
And do you think you can do that without a trade association? You think you can just have sort of a self-governance that's sort of a loose alliance? Probably not, because somebody's going to have to drive some of that accountability. So it's not enough just to say that you abide by the Borrower Bill of Rights. Right, exactly. Probably somebody needs to come in. Maybe that's a place where a firm like KPMG can play. And ultimately, there will be some sort of association where people agree to adhere to certain fundamental, activities and responsibilities. And that's a good thing for everyone, which is why so many platforms signed on to that Borrower Bill of Rights. Okay, last question. I want to talk about I want you to at least look into your crystal ball and say, where do you think we're going to end up when it comes to regulation of this industry? Can you give us your best guess when it comes, where will we be in 3 or 5 years' time when it comes to regulation?
Right. Well, given what came out on the Wall Street Journal this morning about the California Department of Business Oversight, launching an inquiry, change is imminent. I feel very comfortable saying that. But looking into a crystal ball, what do I see? I still think that the peer-to-peer lending is, it's providing credit, opening credit in still somewhat of a closed market. And as long as the platforms can tout that societal good and the impact that they have and the role they play in the broader economic environment, I hope that the regulators will support that, and that instead of restricting the growth of these platforms, that they will work with them. I've talked to many CEOs of some of the biggest platforms, and they are proactively trying to work with the regulators, talk with the regulators, lobby, and stay out in front of it. And I think that will certainly support the success of everyone in peer-to-peer. What would change the glacial pace at which regulation moves will be things like San Bernardino. And maybe it won't be San Bernardino per se, but it would be some sort of a breach of information. And it may not be one of the bigger platforms. It may be one of the smaller platforms, but it will certainly change the pace at which the regulators move in this space, and it will affect everyone in the peer-to-peer lending industry.
Okay, that's fair enough. I think that's great. On that note, we will end. I really appreciate your time today, Fiona.
Absolutely. Thanks so much, Peter.
Okay, thank you. I just want to pick up on one thing that Fiona said there, and that was about the trade association. I've talked about this before. I think the events of this week have crystallized in my mind the importance of gathering the industry into one umbrella. We are being looked at in a similar way. People are putting in Lending Club, Prosper, On Deck, Funding Circle, Cabbage, everybody who makes a loan online, we're all being lumped in together. So I think it really behooves us now more than ever before that we should come together as an industry. Something I'm going to be talking to people about in coming weeks, and I'm hoping that by Lend It in April we can have some kind of organization established where we can move forward as an industry and have a common voice in dealing with the challenges that will no doubt come our way in the future. Anyway, on that note, I will sign off. I very much appreciate you listening. I wish you all the best for holidays and a happy and prosperous new year to all. And we will chat again in 2016. Thank you very much. Bye.